Hello students, how are you? In this session, we are going to discuss a question in under the subject of retirement of partners. Here we will have a one new adjustment, that is transferring the settlement value of the partner to the loan account. That is the difference you can see from this in this question. Other than that, others are normal adjustments, right? So we'll go through that. They said in question, Ganga, Yamuna, and Saraswati are partners sharing profits and losses in the ratio of 3:2:2, respectively. Their balance sheet as on 31st March 2020 as follows. Right? Buildings 50,000, furniture 12,000, motor car 25,000, cash and bank 20,000, debtors 30,000, stocks 15,000, Ganga capital 30,000, Yamuna's capital 20,000, Saraswati's capital 20,000, and sundry creditors 25,000, bills payable 15,000, and general reserve 28,000, profit and loss 14,000. Right? On the above date, Saraswati retired from the business. Ganga and Yamuna decided to continue the business. The following are agreed among the partners. Goodwill of the firm is valued at 56,000. Goodwill of the firm is valued at 58,000, 56,000. That means goodwill account debit. We have to create a goodwill account in the books, right? In that case, goodwill account debit and capital account GYS, Ganga, Yamuna, and Saraswati, according to the profit sharing ratio of 3:2:2, right? That is 24,000, 16,000, and 16,000. Then goodwill account debit, right? Say capital account, right? G, Y, and S, that is 24,000, right? 16,000, right? And 16,000. 3:2:2, right? Then carrying down value is 56,000, right? 56,000. Brought forward 56,000, right? So in capital account, balance brought forward, right? This is balance, right? In this capital account, credited goodwill account. How much? 24,000 and 16,000 and 16,000, right? Goodwill. We have transfer, right? Second adjustment, right? Second adjustment. This is the important goodwill, creation of goodwill when the partner is retired, right? This is important. And second one is, they say stocks and motor car to be depreciated by 10%. Stocks, what is the value? Stocks 1,500. 10% is 1,000. Stocks value is 15,000. 10% is 1,500, right? Then here 15,000 and 15,000. Carrying value is 13,500. Brought forward value is 13,500. Right? This is revaluation account. It should go to the revaluation account. Revaluation account, stocks 1,500. Right? Revaluation account debit and stocks account credit. Other things is motor vehicle. 10% how much? Sorry, 10%. 10% is 2,500. It has to be reduced by 2,500, right? And if it is the reduced by, then carried down value will be 22,500. Then this is 25,000. This is 25,000. Brought forward value is 22,500. Okay. So this 2,500 is a revaluation. Revaluation. Right. This should go to the revaluation account saying motor vehicle to car 2,500. Why? Opening balance is 25,000. On that we have to depreciate it by 10%. Then 2,500, 10% is. So carrying value going to reduce it by 2,500. Then carrying value will be 22,000. New balance is 22,500. So there is a revaluation loss of 22,500 that has been charged to the revaluation account. That means revaluation account debit and motor vehicle credit. Right? Okay. Understood? And third is provide for bad debts, 1,000 rupees. Debtors, debtors is 30,000. What is the provision? 1,000 rupees. 1,000 is the revaluation account debit, and provision for bad debts is 1,000 credit. Right? Provision for bad debts. Right, that is 1,000. Revaluation account debit, provision for bad debts credit 1,000. Revaluation account debit, provision for bad debts is credit 1,000. Right. So we have made a provision. Right. That is a loss for us. Right. Buildings appreciated by 15%. Buildings appreciated by 15% means on 50,000, 15% is 7,500. Sorry, 7,500. It is going to be appreciated. Appreciated means value is increasing. Increased by 7,500. Then the carrying value will be 57,500. Right? If it is 57,500 in the sense, carrying value is 57,500. Brought forward value also 57,500. So the incremental value was 7,500. During the revaluation, it is the profit. It has to be transferred to the revaluation account. Revaluation account, we have to say buildings. Buildings 7,500. Right? Because we have gain a profit in revaluation the profit building. Right? So the gain is credited to the revaluation account, debited to the buildings account, because balance of the building is has to be increased by 7,500. Okay. Trade creditors reduced by 300. Trade creditors reduced by 300 means we had to, trade creditors balance is 25,000. Then reduced by means we had to credit it saying revaluation. Right? Then carrying down value will be 25,000 minus 24,700. Then brought forward value is 24,700. Okay. Then creditors, it is a gain. Okay. 300. Revaluation gain. Profits. Because creditors we had to pay 25,000 at the beginning of the year, before he is leaving. At the time of he is leaving, the partner is leaving, we have revalued, then amount is reduced by 300. Then that 300 is a profit for us. Revaluation profit. Okay. So this says it is decided to pay 18,000 to Saraswati and transfer the balance to capital. Right. Here we have passed the journal entry also, right? Buildings 7,500 and creditors gain, creditors account debit and revaluation account credit. Creditors account debit, right? Revaluation account credit. And next one is capital. We have we paid 18,000 to the retiring partner, right? 18,000. That for what is the double entry? Cash account credit and debited to partner's capital account, saying cash cash 18,000. We have paid to retiring partner. Then capital account is 18,000, right? That is Saraswati. Okay. Then carried down value will be 2,000 and 20,000 and 20,000, and brought forward value will be 2,000, right? So that entry also we have done, right? Balance amount has to be transferred to the loan account, right? Balance account has to be transferred to the loan account. That leave it as it is, right? Here what are the other accounts available? Loan is there, general reserve is there, 28,000. That has to be transferred to the capital account. Capital account of G, Y and S, right? 3 is to 2 is to 1. 3 is to 2 is to 1, right? 4 into 12,000, 8,000 and 8,000, right? On that basis we had to transfer. General reserve account debit and capital account credit. General reserve general reserve 12,000, 8,000 and 8,000, right? And other thing is profit and loss. Profit and loss also has to be transferred to the capital account. Capital, say G, Y and S. G, Y and S, right? G, Y and S. What is the amount? 14,000. 14,000 means 6,000 and 4,000 and 4,000 basis, right? 3 is to 2 is to 2. 3 is to 2 is to 2. Then 6,000. What you call general reserve capital? What you call general reserve account? Sorry, profit and loss account. We had to pass a journal entry for that, right? Ninth, P&L debit 14,000, right? Credit to capital account. Account credit what? G, Y and Z. How much? 6,000, 4,000 and 4,000, right? Being profit and loss account transferred to the partner's capital account, right? Profit and loss account 6,000, 4,000 and 4,000, right? Then we will balance the revaluation account. This is 7,800 is the revaluation account. Revaluation account 7,800. And what is the difference? 3, 4, 5, 5,000, 2,800, right? That means G capital account on G and Y and S, right? G, Y and S, right? That is 12,000, 1,200, 1,200 and 800 and 800, right? 1,200 and 800 and 800. That is revaluation. That also we have to pass the journal entry, right? Revaluation account debit, revaluation account debit, and capital of G, Y, and S. Revaluation account debit 2,800 and 1,200 and 800 and 800. Right? With that, all the journal entries are finished. Right? So we have transfer. Now we have to balance the accounts, right? We will balance it. Balance has to be transferred to the loan account and balance carried down. Carried down, right? Balance brought forward. Balance. Right? Here we will say 20, 36,000, 44, 48,800. Right? 48,800. Here same 48,800. 48,800. Right? Here we can say 48,800. Right? Here we will say 30, 24, 54, 66, 72, 73,000, 73,200, 73,200. Right? This is 73,200, 73,200, and 48,800, 48,800, and 48,800. Difference is 30,800. Right? 30,800 has to be transferred to the capital, from capital to loan account. Right? Capital account 30,800. Right? 30,800. Loan account, the balance is the Saraswati's balance 48,800 payable, right? 48,800 payable. We have paid through cash 18,000. So balance is 30,800. This 30,800 is the loan, right? Loan. We have transferred to the loan account, right? Balance is loan. Here is the loan account. 30,800. So it will remain as a loan payable to Saraswati, right? So we will, that is the new what we call adjustment here, right? We'll take down the balances. Balance 75,000, 73,200, 73,200, and 48,800, right? 1, 2, 1, 122,200. So cash is 2,000. 2,000 is the cash, and goodwill is 56,000. 56,000 goodwill, and motor car is 22,500. 22,500, and building is 57,000. 57,500, and furniture, we have to see furniture. Furniture 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 is 12,000, right? Furniture 12,000 is there, right? So we had to add it. 500, 500, 0, 0, and 1, 8, 10, 12, 18. 18 and 1, 6, 7, 9, 14. 148,800, right? So stocks, buildings is there, 57,500, and provision for bad debts 1,000, then 29,000 debtors, right? Then creditors will be 24,700, right? And loan will be 30,800. 30,800 loan, right? Stocks will be 13,500. Stocks 13,500. So if we balance this, right, 500 and 2, 11, 14 and 1, 44,500, and total assets will be 500 and 2, 192,500, right? Okay. And bills payable is 15,000, I think. Bills 15,000, right? 15,000 bills payable, opening balance, right? So we had to add this one. Okay. P&L finish, general reserve, right? 30,800 we had taken. Provision, everything we have taken, right? Then 500, 1 is there, 0, 1, 5, 7, 70,500. Then 192,500. Okay, it is balance. 192,000 balance. The trial balance is, the balance sheet is balance sheet, right? Here the different is the loan. Cash paid 18,000 to him and balance is 30,800. We have shown as a loan payable. Debtors account, partners capital account debit, and loan payable is credit. That is the entry is done. Here the double entry is capital account. This account you had to be remember, right? Capital Saraswati 18,000 paid, 18,000 capital account debit, cash account credit, right? That amount. And capital account debit 30,800, credited to capital loan account of Saraswati. That is the new adjustment we have learned, right? This is old adjustment. Goodwill, creating goodwill. These two are new adjustment. Okay. Okay, have you understood these adjustments and my explanation, right? So I think it would have been easy for you to follow, and I am going to conclude this session, and I hope to see you in next session with the different question. Okay, thank you. Bye.